The audit risk model. This is perhaps one of the most important topics in all of auditing. It helps the auditor understand the likelihood that they are going to make a mistake. It also helps direct and plan the audit. In order to assess audit risk, that is the likelihood the auditor issues an unqualified opinion when in fact there are material misstatements in the financial statements, is driven by three factors: inherent risk, control risk, and detection risk. Inherent risk represents the likelihood the financial statements contain a material misstatement before the audit begins, before we consider the internal controls, before we consider the possibility the auditor would detect it. This can be measured either qualitatively, i.e. low, medium, high, or numerically, between 1 and some number greater than 0. It is impossible for there to be no inherent risk. Control risk represents the likelihood the controls will fail to prevent or detect an error when present. It again can be measured between 0 and 1, but could never actually equal 0. It too can be measured in qualitative terms: low, medium, and maximum. To say the control risk is maximum means the auditor has no confidence the controls will prevent an error. The auditor would do this for a number of reasons. They don't believe the controls are effective, they don't believe the controls are relevant, they simply don't believe it's cost effective to test the controls. Detection risk is what the auditor controls. It is, again, can be measured between 0 and 1, with never actually equaling 0. This is the only item the auditor can actually control. Inherent risk consists of a number of factors. It is important that you understand these factors. For example, why would the client's business impact? What would be a high-risk business? What would be a low-risk business? The prior audit also is an important factor. For example, if you discovered in prior audits that the management was aggressive in their reporting, that would impact your decision. This is consistent with the auditor acting with professional skepticism. We don't assume management's honest or dishonest, but if we have evidence, we definitely consider that in our decision. Any item which allows management to have discretion is going to increase the inherent risk because it is more difficult to audit. Control risk is an important component because the client has complete discretion over the effectiveness of controls. In Chapter 6 and 7, we're going to actually look at controls and discuss what are good controls and learn how to assess this. But for now, we just want to acknowledge that there is a likelihood the controls will not work. The auditor, whenever they're going to rely on the controls, they have to have evidence to support that belief. They can collect evidence through what we call test of controls. Detection risk is the risk that the auditor will fail to detect a material misstatement when present. Ideally, the auditor would love to design an audit that would eliminate this risk. That would allow them to provide absolute assurance to investors. But because of sampling risk and non-sampling risk, the auditor cannot do this. Sampling risk exists because the auditor will not look at every item, but will draw a sample of items. This is going to be covered later in the course when we study probability proportion to sampling size and test of control sampling. With sampling risk, the auditor can do things to minimize this risk, drawing random samples, using statistical methodologies, but it can never be fully eliminated. Non-sampling risk could also be considered auditor error. This involves the auditor, for example, picking the wrong procedure. Either they lack the knowledge, the training, or supervision, but for some unknown reason they do not select an effective procedure for the task. It could also be they have the correct procedure, but they don't apply it correctly. The final possibility is they have the correct procedure, they apply it correctly, but they don't know how to interpret the results. This is what the PCAOB would call acting with a lack of skepticism, i.e. we don't know what the results mean. We don't have the skills to interpret them, or we have a bias. How you actually use the audit risk model in practice versus theory varies significantly. We oftentimes will rewrite the formula to allow us to state detection risk as the key variable. We know audit risk is set by the audit firm before we begin. We know inherent risk and control risk are going to be assessed based on our interviews and expertise with the client. This will allow us to determine detection risk. Detection risk in this formula highlights the role the auditor uses it for determining the nature, extent, and timing of the audit procedures. When we look at the audit risk model, we in class and in the textbook will sometimes apply numbers, but in practice it is more abstract, assessed in qualitative terms. Note, you would always either use quantitative or qualitative, but never mix the two methods. If we're ever going to set control risk below maximum, then we are going to implement what's called a reliance strategy. This is where we're going to trust or rely on the controls to provide us evidence of the absence of material misstatements. Before we can do a reliance strategy, we first need to understand the controls, and then we would need to determine whether we could confidently assess control risk below maximum. We would still need to test the controls to provide confidence in this decision. For some private companies, we may actually elect to do a substantive strategy. This was very common pre-2000, in which the auditor would look to the controls only if it was cost effective. However, for public companies, the auditor is required to do an opinion on the internal controls, and again, we will discuss that in Chapter 6 and 7. There would be 3 reasons why you would not look at controls in a particular setting. 1, the control may not be relevant. 2, the control may not be effective. If we don't believe a control is effective, it would not be cost efficient or wise to test it. There are limitations to the audit risk model. It does not consider the possibility of audit error explicitly. It also does not consider that there may be errors between what the auditor aspires to do and what they actually do. This can exist, for example, where the auditor expects or hopes to achieve an audit risk of 0.05, but only achieves 0.1. The reason why we continually talk about detection risk being such an important factor is it determines the amount of evidence we're going to collect. The lower the detection risk, the more evidence we're going to need. Lowering the detection risk means we want to be more confident that we are going to find all errors. If we want to be more confident, we're going to need more evidence. That evidence can be of a better nature, more extensive, or gathered later in the audit. Again, consider the nature, extent, and timing of the audit procedures. This figure, which is replicated from the textbook, helps us understand the interrelationship between these many variables. As the acceptable audit risk decreases, this is going to cause certain factors to change. For example, audit risk will influence the detection risk and the planned evidence, but audit risk would not determine inherent risk or control risk, as these factors are based entirely on the evidence the client presents us, not the evidence we want to see. Tolerable misstatement is the final element of this model. That represents the largest error the auditor could find and can still conclude there's no problem. The smaller the error we're looking for, the more evidence we need. Again, this highlights the nature of the audit, that we are going to be looking at both the acceptable and achieved audit risk. Acceptable is what we aspire to do, achieved is what we actually do. The acceptable audit risk will be factored by a number of factors, including reliance by external users. A public company would have a lower acceptable audit risk than a private company. The likelihood of financial failure will also be considered. Both of these are going to be driven by litigation concerns. The auditor, if they are facing greater litigation risk, will want to be more confident in their opinion. Also, if the auditor thinks management may be of questionable integrity, they will want a lower audit risk to provide further protection. The achieved audit risk is going to depend upon how well we actually do our audit. If we do not correctly assess control risk or inherent risk, then we are not going to determine the correct detection risk. Our detection risk will actually depend upon the evidence we gather. We will oftentimes want to improve our audit or reduce detection risk. In order to do this, we can only manipulate the 3 variables: inherent risk, control risk, and detection risk. Inherent risk can only be reduced if we have new evidence which suggests our initial assessment was wrong. It can never be adjusted based on auditor need to have a lower audit risk or the auditor's desire to collect less evidence. Control risk can only be changed in the presence of evidence. The auditor may elect to not consider controls, i.e. set control risk at maximum, but then later on in the audit recognize the need to rely on the controls. This would allow them to reassess it, but only after they have conducted tests of controls. To review, inherent risk is based on our initial risk assessment. It could only be changed based on evidence. Control risk may be assessed at maximum before we begin. Thereby, we might have the option to later on reassess this decision, collect more evidence. In terms of reducing detection risk, the auditor could adjust the nature, extent, and timing of their audit procedures. This is a critical topic for the upcoming test, and I wish you the best of luck.